Hello, everyone. We are going to go ahead and get started. Welcome to today's webinar, GBQ Quarterly Year-End Individual Tax Update, sponsored by GBQ Partners, LLC. Today's presenters are GBQ's Tax and Business Advisory Services Director, Scott Eicher, Senior Manager, Jen Zimmerman, and Manager, Rob Roll. Now I'll turn the call over to our presenters to start today's webinar.
Thanks, Carrie. Welcome, everyone. Happy December 2021. It's fun to be with you all virtually, and I think we're coming from our home offices today. So we're still hybrid at GBQ, and we're in the office most days, but sometimes we're home as needed. We're excited. The holidays are just around the corner, which, you know, obviously we got our Christmas lights and we're getting those out, getting ready. But we also, you know, are getting excited about year-end tax planning because we're tax nerds. So we're excited to cover a lot of topics today. I'm Scott Eicher. As Carrie said, I'm a director in our tax practice here at GBQ and work primarily with the middle market and high net worth individuals, closely held businesses. I'll let Jen and Rob introduce themselves.
Thanks, Scott. So my name is Jen Zimmerman. I, like Scott, work primarily with high net worth individuals and business owners. Business owners are really my bread and butter, and I love talking to people about what their business has been up to. Especially the last couple of years, it's been a wild ride. I think we can all agree that we haven't really known what to expect since COVID hit, and that trend has continued throughout 2021. I'm hearing a lot of stories about how things were looking up and now they're down, and now we have no idea how to budget for 2022. So it will be fun to be along with you for that ride, but for now we'll be focusing on the 2021 changes for individuals on this presentation.
Thanks, Scott and Jen. My name is Rob Roll. I'm a manager in our tax department here at GBQ. I have a couple main areas of focus, the first of which is working with Scott pretty heavily in our private client service niche, as well as working with our transaction advisory services group. And then as well, I do a lot of work with investment managers, you know, call it private equity / venture capital funds, doing a lot of work there. And I think Jen kind of went through, you know, our clients have a lot of ups and downs and roller coasters and never sure what's around the corner in their businesses. But there's also been a lot of that this year in tax law with the change in administration that occurred earlier this year and all the proposals being thrown about in Congress. And so we're looking forward to kind of giving you an update there, what's on the table, what's not on the table, and what might just happen before the end of the year.
All right, next slide, Karen. Yeah, so as Rob mentioned, there's been a lot of, you're probably getting sick of hearing about tax changes and potential tax changes in the news. It's been a wild ride since, you know, kind of going back to 2020 even, and some of the stuff that passed. But so there's a lot in 21 that we know has changed, whether it's as a result of the spending bill that passed at the end of 2020 or the American Rescue Plan Act that was passed earlier this year. And then we're going to also get into the exciting stuff, right? The potential tax changes that could be coming here even before Christmas if the Senate were to pass the House Build Back Better Act. So we're going to cover everything that's in the Build Back Better Act, specifically in individuals. And we also are hosting a business update tomorrow. If you still have time to RSVP for that on our website, that will cover the business tax changes. I'm going to highlight a few state and gift tax items because those continue to be timely right now, and there's some changes coming down the line there, some things to think about, and then other kind of traditional tax planning and just year-end charitable giving strategies. With that, I'm going to kick it off to Jennifer to start us off.
All right, so our slide deck here picks up where essentially we would have left off during last year's webinar. We did not know about the Consolidated Appropriations Act, which passed at the end of 2020. Like Scott mentioned, this was the act that was snuck in right at the end of the year. And while most of it related to 2020 when we're talking about tax impacts, I did highlight a couple things on this slide that related to 2021. One specifically, the increased above the line charitable contribution deduction. We'll talk about that a little bit later, but I wanted to also point out on this slide that the chart here is focused on the second stimulus payment. So in the tax world, we call these economic impact payments, but I feel like everyone outside of the tax world called them your stimulus payments. And this was the second one of $600 each. So if you kind of find where you fell on this chart, maybe you specifically, or if you're a tax professional, one of your clients, the thresholds and where the amounts, I guess, diminished to zero could have been up to $200,000 or more if you had more dependents. And so what this means is that if your income exceeded these thresholds, then you were getting no money. Otherwise, you were getting some amount of money. And I think I can speak for Scott and Rob when I say that we were getting lots of questions from family and friends and clients. How much money am I getting? When am I getting it? And this and that. So if you go to the next slide, then we went from the Consolidated Appropriations Act at the end of 2020 to the American Rescue Plan Act, ARPA. And this was the act that was signed by President Biden in March 2021 that had the third and final economic impact payment. And so this chart lays out, it wasn't just the stimulus payments that this act covered. The things that I'd like to highlight that we'll be covering in this presentation, besides the stimulus payments, expanded the child tax credit quite a bit. We'll get into some details of how that tax or that credit is administered. Some people have already received part of their money, and we'll talk about that. It's also calculated a little bit differently. So if you didn't receive the child tax credit in years past, you might be eligible for 2021. So that's kind of exciting for those of us that have kids. It also expanded the earned income tax credit to individuals, lower income individuals that don't have dependents. So there was an expansion there that was intended to help people quite a bit. And then it enhanced the child and dependent care credit. So think daycare costs or that sort of thing. If you're paying for your children to be taken care of while you work or are looking for work, even if you weren't eligible for this credit in the past, or maybe if it was minimal, you might have more money coming to you for 2021 when you file your tax return. So a lot to think about there that was passed as part of ARPA in March 2021. The other things that we aren't covering in our slide deck, but that I'll mention real briefly, we have a whole team at GBQ that has been focused on the employee retention tax credit. So on this chart, the very top line, ERTC, like it expanded the ERTC a little bit longer, and it's been ongoing. That team can tell you all about it. It's outside the scope of this presentation, but this hit on that a bit. And then also, I had one other thing there. Maybe not, nope, other credits. Okay, next slide. So on the next slide, there we go. So the stimulus payments, the third round, the dollar amounts were higher and it applied to a lot more people. So in the past, we had payments of $1,200, we had payments of $600. Now this third go round, it was $1,400 per person plus $1,400 for each qualifying dependent. And that was up quite a bit from the first two rounds also. It also expanded the definition of dependent from being children under the age of 17 to any qualifying dependent. So if you had your elderly parents on your tax return because you've been taking care of them and they've qualified as your dependent, you should have received money for them. They also, we'll talk about the income phase out amount in a bit. I kind of alluded to that earlier, and that's on the next slide. But each iteration of this changed a little bit. And so the third round was no different. Dollar amounts were different, applied to different people. And they also tried to do a bit of a true up payment where maybe if you didn't receive the first two rounds based on your 19 return, but you've since filed your 20 return, maybe you get a little bit of a true up there. And if they paid you a lower dollar amount than you should have received, they might have done a quick adjustment there too. So that's what this additional plus up payments section is applying to also. Next slide. So remember the slide I told you about initially like, pay attention to the phase out limits. The big change that I noticed with some of my clients is they might have received the first 2 rounds of payments because their income amount was somewhere in between 150 and 200. Well, it dropped off drastically here. I keep pointing to the slide, and you guys, that probably doesn't do much here in this virtual environment. But the third round, if you were a married taxpayer, if you made above $160,000, no cash for you. There was no phase out that could apply to you. It wasn't gradual. If you have lots of kids, it's not like you got more of a phase out. It was just a quick drop off there. So I know I did have some clients that applied to there. The phase outs, this chart does a great job of explaining it, so I'm not going to walk you through the dollars. If you have questions, talk to one of us. Next slide. And I think that's enough about stimulus payments. There has not been a 4th round. I don't seem to be getting that question anymore. So, but just FYI. Charitable contributions. So I hit on this a little bit ago, but the deduction they created with the CARES Act an above the line deduction for taxpayers that don't itemize of $300. So let's say you don't have enough itemized deductions to otherwise itemize, but you still give to charitable organizations. This is essentially $300 off of your taxable income that you can deduct. And the slide lays out what cash contributions still don't fall under this bucket. So if you make cash contributions to a donor advised fund, if you have carryovers, if you make them to non-operating private foundations or charitable remainder trust, that doesn't count for this deduction. Think like, the money that you give to your church or this or that. And then cash, occasionally we'll get this question. I think later on in the presentation we hit on it too, but cash doesn't mean just like dollars in the Salvation Army bucket at the grocery store. It could also include writing a check, credit card. It also includes unreimbursed out-of-pocket expenses in connection with volunteer services. So I thought that was kind of interesting. If you're volunteering for some charity, if you, incur expenses as a result of that charitable operation, you can deduct it here too, even though it's not quite cash.
And just to maybe underscore one more point that Jen was making on the cash, that does not include, your donations to Goodwill and your other various donations such as that. So usually when we talk about non-cash donations, in the tax world, at least, we think of securities, but non-cash donations also includes your, various household items you give to Goodwill. Those do not count for this above the line deduction.
Thanks, Rob. Yeah, I think occasionally we'll get like itemized detailed receipts of the Goodwill contributions, like I moved and so I have all this stuff to give away and I gave it to Goodwill and we assign an amount on it based on the fair market value of those items. That is not cash, so that also doesn't fall in here either. Next slide. So the final thing that I'll highlight here, just because it is relatively new for 2020 and 2021, is that if you itemize, so this is outside of the $300, $600 limit that I talked about on the previous slide. If you itemize, you can take advantage of an increased limit of up to 100% of your adjusted gross income, AGI. Any amount above that 100% still carries forward for 5 years, and non-cash property does not qualify.
Yeah, this is a big one. We've been doing a lot of planning with clients that have a lot of charitable intent and maybe a lot of wealth, but not as much kind of income in the current year. And because it allows them to shift a lot of money to charity and completely wipe out your income, which you wouldn't have been able to do before using charitable contributions. And I just want to say, if you're making large gifts, make sure you're working with the tax advisor at GBQ to kind of maximize these, because if you're doing a combination of stock and cash, or you have carryovers from the prior years, there can be a lot of kind of complex ordering rules here of how those limitations all work together. Because while cash is still at this 100%, as you can see below, non-cash doesn't, and that also includes capital gain property that's at the 30% limit, also doesn't qualify. So if you're using stock, there's a different limit that applies. So yeah, continuing to work with clients on this, and especially if you're making kind of multi-year gifts or something larger.
Thanks for that, Scott. On the next slide, then, I wanted to highlight here a couple things that have kind of reversed from the rules that you might have known them under the CARES Act. So, and if I take you back, if we go back to 2017, the TCJA passed the Tax Cuts and Jobs Act under President Trump, and that changed a lot of rules that we had all been following for some time. So we had to learn that whole new system. And then when the CARES Act passed in March 2020 with COVID, it changed some of the rules as it relates to net operating losses and excess business loss limitations. So we kind of had new rules come into play, then those rules were reversed. Well, now we're back to the TCJA for 2021 as it relates to these two specific items. So for net operating losses, the rule now is that you can only offset 80% of your taxable income with NOLs, and you can't carry net operating losses back, but you can carry them forward indefinitely. So if you, over the last year or so, since COVID, since then, you might have had a situation where you were carrying losses back 2 years, back 5 years, carrying them forward for 20 years. Well, now forget all of that again. We're back to the TCJA rules for net operating losses. And then excess business loss limitations, I see this a lot with my clients, and it was something that we were all excited about educating them on after the TCJA. Your business losses will be limited to an inflation-adjusted $250,000 or $500,000 for married filing joint taxpayers. So what this means is if you have someone that gets a W-2 and it's 300 grand and they have a business, so maybe a Schedule C, that loses 300 grand, you would like to be able to say that offsets it and no taxable income and you're done. Well, under this excess business loss limitation, if you're a single taxpayer under the situation that I just described, your loss is limited to, for 2021, $262,000. That's the inflation adjusted $250,000. So you actually still have income. With the excess loss coming forward as an NOL into future years, forever, not carried back, if you look at the NOL rules above here. So it's a lot of ins and outs, and that's to say if you have a situation where you think this might apply to you, be talking to your tax person. I think it's something that can tend to sneak up on you, especially since it was a new rule, and then it was a rule that we kind of forgot about for a couple of years, and now it's back again.
Yeah, as Jen said, especially if you had a business that was, you maybe have multiple businesses, but one was losing a lot of money, and depending on the definitions and what you have going on, you may still have a lot of wages that you think can offset that, but you can end up in a really kind of adverse situation. And these rules really haven't been around long enough that you've had to really deal with it. The other thing on the net operating loss, I just want to point out for 2020, these tax returns that were just filed as late as October, if you did not elect out of the carryback, you're required to carry back that NOL. So if you had an NOL on your 2020 tax return, it's required to be carried back 5 years unless you elected out of that and elected to carry it forward. So just something to keep in mind.
Yeah, I think these rules, especially the excess business loss limitation, this was a totally new concept with the TCJA. So a lot of tax practitioners had to get up to speed on it quickly and then forget about it for a few years. And now we're back to it again. So definitely be thinking about it and talking to your tax person.
Well, Jen, one other just tax savings tip. If you're listening to this and you're like, oh, I was subject to that limitation in 18, 19, or 20, it's probably unlikely you'd have been subject to it in 20 because the software and tax software knew the rules then. But definitely for 18 and 19, a lot of returns were filed with that limitation. So in a lot of situations, there's refund opportunities to go back and file to reverse that excess business loss limitation.
Well, and these rules were changing so quickly that sometimes the tax software was taking a while to update too. So it's been fun lately. On the next slide, then, I just am hitting briefly here on required minimum distributions are back. They were paused for 2020. If you were required to take them, you didn't need to for 2020, back again for this year. And on the next slide, I believe we have our first code word. So everybody go to your computers, punch in individual. Individual is the first code word, individual. It looks like it's the first one on my screen. I don't know if it's the first on yours or not, but individual, first code word. Hopefully everyone is punching in individual on this code word section. All right, so the next section, which I'm really excited to tell you about, for those of you that know me personally, I had a child this year, and so I am now up to 2 children. So when we talk about the child tax credit, you know, now I can look at all these numbers and look at them a bit differently for myself since I have doubled my child tax credit opportunities. The child tax credit expanded quite a bit under the American Rescue Plan Act in 3 key ways. So it was made fully refundable. So meaning if you had credit in excess of the tax or tax liability that you would have, it could be refunded to you instead of being subject to various limitations. The dollar amounts that you could get have increased from, they were $2,000 per qualifying child under the age of 16, and now it is $3,600 for a qualifying child up to 6 years old, and $3,000 for each child between the ages of 6 and 17. So that's kind of a lot of numbers that I just threw at you, but basically we went from either 2 to 3,000 or 3,600, and the age amount or age limit expanded from 16 under the age of 16 to under the age of 17. So for parents, this is great. And then the last point, which I think this was in the news quite a bit, part of the child tax credit could be advanced to you during the last 6 months of 2021. So if you heard people start talking about more stimulus payments, if you paid attention to the first part of this presentation, you know there was no 4th stimulus payment, but there were child tax credit advances that were paid to you. I think it was a common misconception that this is like another stimulus payment. Here the government is giving us more money, but I have been trying to tell people, anyone that will listen to me, that this is not a stimulus payment. It's a benefit that you would have been getting on your tax return anyway. It's just being advanced to you during the year. So there will be a true-up process on that. And I think the other thing that I wanted to highlight on that, the IRS is supposed to send everyone that received these payments a letter detailing which payments they've received. Save that letter. We're supposed to get it in January 2022. Save it, put it with your tax stuff, give it to your tax professional. Scott and Rob and I would greatly appreciate your diligence in this matter. I think we could get into the nitty-gritty of this, but for the sake of time, I think I will go ahead and keep things moving. If you have specific tax questions on the child tax credit, though, feel free to reach out to me and I'm happy to help. Finally, the child independent care.
Before we move on, if I can make a comment, you know, the IRS is sending these payments out to people based upon their most recently filed tax return and assuming everything was the same. So if you're, you know, a situation I had actually with a client, they are you know, they have a kid, but they're divorced from the kid's mother. In that situation, they claim a dependent back and forth every single year. So the IRS is sending my client these monthly payments, and the IRS expects that client to get the child tax credit. The taxpayer won't get the child tax credit, so the client's actually going to have to quote unquote pay back the amount of the advances they're receiving. So, you know, to kind of underscore Jen's point, these are not stimulus payments. These are not free money. They're just an advance in some sorts, you can view them as a little bit of a loan on your tax refund or overpayment.
Yeah, and for some clients, I think the payments have recently changed, or you will see it change in December if you didn't in November, because if you filed close to October 15th, all the IRS has really had is your 2019 return to base those off of. So that now they'll have their 2020 return, which may change your November and the December payment that'll come out on the 15th. And then 21 will be kind of this real true up year of, what are you actually due as far as a credit? So you could be dealing with 3 years of reasoning as far as, if you had large losses in 19 and they're being advanced these credits, even though in 2020 you had a huge income year, it may seem confusing, but that's the timing of what information the IRS has.
Yeah, and everything, it'll get trued up on your 2021 tax return, which, to Jen's point, please save that letter you're going to get or give us a listing of what payments you received for this. That will help us out immensely.
The IRS has lots of frequently asked questions on their website. So in Rob's situation with the client that they trade the child, who claims the child year over year, there's a lot of details as far as like, what if your situation is this or that or the other, who's owed the payment, what do you do if you got the payment, you weren't supposed to get the payment. So sometimes it takes asking your tax professional just to dig through those frequently asked questions. I think the IRS was kind of building the cart as we go on this one, just because it all came out so quickly, and then they needed to push out the funds. The rule changed in March, and then they started distributing payments in July. So really, that was a pretty quick turnaround to start getting money out to the masses on this. The final tax credit that I wanted to just hit on briefly here is the Child Independent Care Tax Credit. I mentioned this earlier, but this is if you have daycare expenses or the like for children under the age of 13 or other dependents that aren't able to care for themselves. That credit went up a lot, and it's not just, it might have been something where the amount that you got was pretty minimal, but now the credit, it applies to more dollars that you're spending on these expenses, and the credit's a little bit higher. So even if you think that you wouldn't have applied or qualified for the child tax credit, the one that we just talked about, or the child independent care tax credit, take another look at these for 2021, because the buckets for who gets these credits has expanded quite a bit. Next slide. All right, and then this tab is just some of our more traditional changes. Standard deduction went up, the flex spending account limit has more than doubled, and the EITC, I already talked about this earlier, but it expanded also. So now I'm going to turn it over to Rob to talk about Build Back Better, Biden's Build Back Better bill, currently in the Senate, passed the House. We will see if things will change. We're thankful that things did not change right before this presentation, because we would have needed to change our slide deck quite a bit. So Rob, on to you.
All right. So if we go to the next slide real quick, we can start kind of going through the provisions of the Build Back Better bill as passed by the House. So the House passed this a couple of weeks ago. It was a pretty close vote, pretty much along party lines in the House there. But it's only passed the House at this point and not the Senate. So the final form and timing of the Senate bill are still unclear. Listening to some news sources yesterday, the Senate can bring it up for a vote as soon as December 15th, which ironically is a day that Jen and I have another presentation like this. So I'm hoping they maybe wait to the 16th to do that. But at this point, the Senate's got 3 options. They could pass the House bill as is, no changes. Then it will go to President Biden's desk for signature. The other alternative is the Senate passes their own bill or amends the House bill. At that point, it could go back to the House. Or if the Senate does change it, the House and Senate could come up with a conference committee, hammer out their differences, and it goes back to a final vote in either house, in both houses, prior to going to President Biden's desk. All that to say is it's close at this point, but there's still a lot of things that can go wrong and derail this. Or I guess going wrong is a matter of opinion, but there's still a lot of things that could derail this bill from becoming law. So just something to keep aware of. message me after if you want to talk about Senate parliamentary procedure, because there's some quirks there I'm not going to go into now.
But really, Rob, what this hangs on to is, it's in the Senate where the Democrats have a slim majority, even slimmer than the House. And throughout 21, there's been a lot of vocal opposition from either Joe Manchin of West Virginia or Kristen Sinema of things they want in there. But the balancing act is if the Senate makes too much changes, then in the House, there's also some more progressive Democrats that want certain things in there. So it's just, we could pull out our crystal balls and make predictions, but we really don't know. Just because it's changed a lot, even since this framework Rob's going to go through is going to probably, if you've not been following it closely, sound very different than it did at the beginning of the year and what some of Biden's campaign promises were. So it's a very different bill that the House passed than even we were following all this summer. So it could change again that quick.
Absolutely. So we're going to go through again what's passed by the House, what the final bill looks like, and what becomes law is still very much up in the air. But I don't think there's going to be wholesale changes in the Senate. It'll be some things here and there. So I think going through what's in the House bill is a very good exercise for everybody to become more informed. So the headline thing there is a 5% surcharge on modified adjusted gross income exceeding $5 million for married and filing separate, or $10 million for all their taxpayers, with the trust level set significantly lower there. And then on top of that, there's an additional 3% surcharge on modified AGI in excess of $25 million for individuals. I have underlined here modified AGI. This is before any of your deductions for your, we talked about earlier, their charitable giving. This is before the Section 199A qualified business deduction. So they really tried to, use the biggest number possible when figuring out the rate to use and the base to have this tax on. This is a surcharge, very much similar to your net investment income tax or your high income Medicare tax. You're going to pay it no matter what. So say you make $25 million in a year, but as Jen mentioned, you write it, assuming, down the road here, you make $25 million in a year, but you write a $25 million check to your favorite charity. If the 100% of charitable contribution limit that Jen mentioned is still around at that time, that doesn't matter. You will still pay the surtax. You might not pay any quote unquote regular tax, but the surtax will still hit you in that situation. And it extends the 2021 changes of the child tax credit that Jen just went through all the way through 2022, with the exception of, so in 2021 here, I have a 20-month-old, so I have been receiving for the last 6 months payments every month. However, if this bill passes in 2021, you will receive 12 payments, so your payment amount will be cut in half. You'll just receive them throughout the full year. And this also makes the child tax credit permanently refundable.
Yeah, it'll be interesting how much political pressure there will be once, there's going to be a lot of, I think, things in the news once the last child tax credit goes out December 15th, because this has really been touted as something that's helped with child poverty and low income families and not waiting to file your tax return to get the dollars. But it is expiring here in December if the Senate doesn't act and Congress doesn't pass this.
Next slide, please. So the next provision we want to talk about would probably affect a lot of our clients, probably more so than the surtaxes I just talked about, is the net investment income tax revisions. So the revised NIT rules would broaden the types of income subject to the net investment income tax. So it would apply to the greater of the old net investment income tax, that's the current definition we've been working under since the Affordable Care Act passed, or quote unquote specified net income. So specified net income is broadened to include investment income, even if it has been earned in the ordinary course of business. So that's business from a pass-through entity, as long as that income has not already been subject to self-employment tax. Currently, the NIT, you back out your income from pass-through entities if you are active in that trade or business. The new version of the NIT doesn't care about that. It only cares if that income has been subject to self-employment tax or not. So boiling it down to the simplest part, what this is trying to hit is income pass-through to taxpayers from S corporations for those taxpayers who are active in the business. because S corporation pass-through income is not subject to self-employment tax. It is in most instances partnership income is passed through, but not S corporation. This would subject the active, if you're active in an S corporation and otherwise cross the thresholds we're going to see in the next slide, your income from that S corporation would be subject to this extra 3.8% tax, where it currently is not.
And this is a big deal. I guess of all of the provisions that we're going to touch on today, this is one that I'm watching closely. I think I can speak for the guys when I say this too, is everybody's asking, what do you think will be in and out? It's like, well, gosh, I hope this one's out for my tax, for my clients, but who knows? And I think also it's something that it makes it difficult for us to plan. So be gentle to your tax practitioner when you hear about proposed changes like this.
For sure, and I think just to add on to that, it raises bigger questions of, well, should I convert back to an LLC? How do I do that? How temporary are these rules going to be? We know none of these are going to be permanent forever. So there could be a lot of questions that come up. I mean, the net investment income tax, remember, came in to law through Obamacare and the Affordable Care Act, and was almost, struck down by the Supreme Court as unconstitutional. And there was talk of even getting refunds of NIIT that have been paid. Now we're seeing an expansion of NIIT. So it just shows how much things have changed. But yeah, I mean, Jen and Rob hit it, nail on the head. Is, this could have a huge impact on large S corporations and may really diminish the benefits of being an S corp.
So this is a little quirky, but the new NIIT rules would only apply to individuals marrying and filing jointly with AG $500,000, whereas the old NIIT rules, which would still remain in force, apply to people over, married filing joint over $250,000 and modified adjusted gross income. So you really end up with this. It's being lumped into the NIIT code sections, but you really do in this situation have two different taxes at the end of the day. So this is probably just something quirky, I think, as tax professionals just find in these things that we just find interesting. I know that's why I put this slide together. So, all right. So the next thing to think about, this is really going off what Jen was talking about the excess business loss limitation. So as Jen mentioned, the excess business loss that was limited in her example converted immediately to an NOL and could be used in the next year. That's the current law. That's how things are currently treated. Under the Build Back Better bill, they would take that loss that was limited and put the next year, instead of being an NOL available to offset, automatically available to offset income, it would take that limited loss and put it back at the top of the calculation for the next year when calculating if you have an excess loss limitation of the next year. So what they're doing, this is really just a revenue raising mechanism they're using in the bill. So instead of, whatever was disallowed in one year can be used the next year, they're trying to meet it out and to not allow taxpayers to use the very next year use a huge chunk of loss. They're trying to meet the losses out over time as a method of raising revenue. The next bullet point is a big deal a lot in my world. I'm hearing a lot about it given the work I do in the venture capital space. It reduces the exclusion for gains on qualified small business stock from 100% to 50%. So under certain situations, and you have to jump through a lot of hoops to get a stock in a company that's sold that you own to qualify as qualified small business stock. But if you get there, your gain up to $10 million was excluded from your taxable income, which I don't know a single other portion of the tax code that lets you, exclude $10 million of your income. So which is a big deal, especially in the venture, like I said, in the venture capital world, the startup world, the emerging growth company world. A very big deal, and a lot of reasons why qualified small business stock had to be C corporation stock, and a lot of reasons some newer companies structured as C corporations in the first place. Under the Build Back Better plan, the taxable half of the gain would be subject to a 28% tax rate. So your effective gain on your qualified small business stock is a 14% capital gain compared to 20% for any other stock. So the delta from 0 to 20 is now from 14 to 20, not including the fact that the exclusion was an adjustment for AMT, So you're probably paying AMT if you have qualified small business stock now. Once that's all, you put all in the calculator, the effective rate on Section 1202 gain would be about 16.88%. Again, up from 0 where it is now. And this applies to sales occurring after 9/13/2021. So as of a couple months ago when this idea was first floated. So this is somewhat retroactive. Applies to sales occurring. That's a little vague. My apologies there. If you have a binding agreement, a merger document signed before that date, you should still get the 100% exclusion. The deal did not have to close before that date. You just have to have a definitive merger agreement or some sort of definitive acquisition agreement prior to that date to get the 100% as opposed to the proposed 50% exclusion.
But they put that date in there, I think, to keep taxpayers from just triggering these sales before the end of the year or rushing
Yep.
to close these deals. So
Yep.
Not a lot you can do at this point to avoid that, or just it's a little bit of wait and see, I guess.
Yep. Just be aware of it is the main thing that you can do at this point. Next slide. Yep. All right. This is everybody's favorite to talk about for sure. And this is what's actually causing the biggest differences between the House and the Senate at this point. The Build Back Better bill increases the SALT deduction cap from $10,000, where it's been since the Tax Cuts and Jobs Act, to $80,000. And importantly, this is the only, besides what I talked about, the qualified small business stock, this is the only portion of the bill that applies retroactively back to the beginning of this year. Everything else we've been talking about would, generally speaking, would start on 1/1/2022. This is the major thing that is retroactive to the first of this year, and extends the SALT cap through 2030. It would be $80,000, and then in 2031 it would come back down to $10,000. So the reason this is the most controversial thing is because it's the lifting of the SALT cap from $10,000 to $80,000. The biggest beneficiaries of those are high income taxpayers, who are exactly the people the Democrats, at least politically, don't want to say they gave tax cuts. But that will be the end result if this comes about, around. Also, we were talking before this call, I think all three of us on this call will also get tax cuts if that happens, because we're all homeowners and real estate taxes are a pretty penny here in Ohio. So that's the biggest thing that could be retroactive, and also the biggest political sticking point at this point is the SALT cap deduction. I do know that Senator Sanders, Senator Bernie Sanders, the Democratic Socialist in the Senate, he has said that he doesn't like the SALT cap. So he's thinking he doesn't like raising the SALT cap to the benefit of high income taxpayers. So he's thinking of putting a cap on the SALT cap for those taxpayers making over $400,000. Or, the math is, he hasn't released quite the math, but if your taxable income is over X, you only get the $10,000 and not the improved $80,000. So we'll see where this lands. But this is definitely the biggest thing subject to change, but also would probably have the biggest impact on the number of taxpayers affected by the change.
Yeah, and what this means probably practically, I mean, if you don't want to wait up until Christmas when the Senate probably votes on this thing and then have 4 days to prepay your state taxes, is if you can control it and reasonably have the cash to do so, probably increase your state and local taxes to 80 grand at least before the end of the year. And then you don't really have to worry about it. Obviously talk with your tax advisor and look at that, but that might be a practical consideration.
Yeah. And then the last slide I could go back a slide. Back one more. There we go. Retirement plan changes. So the biggest, most important thing to remember from these bullet points is that first one, the elimination of all taxpayers, regardless of income level, to convert after-tax after-tax IRA contributions into Roth IRA accounts after this calendar year. This is the elimination of the quote-unquote backdoor Roth IRA. Had been floated a lot, talked about. I've described it as the closest thing to an actual loophole I see on a day-to-day basis that people take advantage of. The Build Back Better bill would eliminate that. And then there's the other 3 bullet points would apply to people with very, very large IRA balances, require distributions, or prevent you from contributing more to IRAs if your balances are over $10 million, for example. All right. So next slide, please. All right, this is my last slide before I hand it over to Scott. So we talked about earlier how many things have been flying out there, how many proposals there have been. Here's just a partial listing of the things that were out there, were in some bill at some point, but did not make it into what the House passed. Just straight up increasing marginal rates, carried interest. It seems like it's always discussed. Then there's a lot of estate planning things that would have taken a lot of tools out of our and attorneys' toolboxes with regard to estate planning. Those did not end up in the bill. But the way I would think about these, I wouldn't just say, "Phew, I'm glad that didn't happen." I would think about these as potential zombies that could always come back depending on the political climate. So the fact that these have been floated probably means more likely down the road, whether it be 2 years, 5 years, 10 years, that these proposals will probably be resurrected in one form or another. So something to think about there. Before I hand it off here, I do want to mention something I forgot to do at the top, talking about Senate procedure and how this needs to happen. Just doing this bill would be a lot for the Senate to get done in 20 days here or so, 24 days before the end of the year. But the Senate and the Congress in general also has to prevent the debt ceiling from being breached, to increase the debt limit so the United States doesn't default on its government debt. That needs to happen sometime between now and December 20th, my understanding. They also need to fund the Pentagon, the military and the Defense Department. That needs to happen before the end of the year. So there's a lot of things that have to happen in the Senate before the end of the year, and this included. So they're going to have a busy work week for the rest of the year. They can't just take the holidays off, I don't think, in Washington there. So a couple other things to keep in the back of your mind as you're here, as you read various news sources and read various things coming out of Washington. And with that, I think it's going to hand it over to Scott, talking about some general estate and gift and other year-end tax planning ideas.
Yeah, thanks, Rob and Jen. Great job. Rob, I think, Rob, a lot of us are watching college football bowl games this time of year. Rob's watching C-SPAN to follow the latest developments in the Senate procedures. So we appreciate all the stuff he does for us on the legislative side. As Rob touched on, there were a lot of gift and estate tax proposals on Biden's wish list. The three of us did a panel a year ago after the election talking about what was on Biden's wish list in the estate and gift world. There seemed to be a lot of momentum for lowering the exemption of how much could pass tax-free under the gift and estate lifetime exemption. There was talk of even larger proposals like repealing the step-up in basis or taxation of unrealized capital gains at death. That would be huge items that would impact a lot of clients. The good news is that the current Build Back Better framework did not include any of these proposals. So even all the changes to grantor trusts or limits on minority discounts, which allow you to discount for lack of marketability or control. So a lot of stuff that could have been. It may be, like Rob said, a little precursor to what the agenda in this area looks like in 22, as Democrats probably still maintain their control of the House and Senate. In the White House, kind of going into the election, will we see some of these resurface after the Build Back Better Act? So next slide. Now, although some of that urgency has gone away, what most estate and gift attorneys would tell you, what we would tell you is now is the time to be still making gifts. And that's because even if Congress does nothing, we are dealing with a sunset in 1/1/26. It's not the beautiful Florida sunsets, it's a tax sunset, which means the current exemption, which in 22 goes to 12.06 million, would revert back to 5 million plus inflation. So it's a big deal because it takes, who's dealing with the estate tax? Well, right now, only if you have a taxable estate above, as a couple, 24.12 million in 22. and it would take that all the way down to people with a estate of roughly, 11 or 12 million. So depending on the inflation adjustment. So that swing could capture a lot more people. So there are a lot of easy ways to use up that exemption and plan accordingly. But I think it's worth starting that conversation now here in 21, early 22, versus waiting too far out there, close to that 1/1/26, as well as the potential for changes in 22, because we know they are on this administration's wish list. Next slide. Oh, and we got second CP words update. So go ahead and click update on the poll. Make sure you get CP credit.
Well, and while you're clicking update on the second poll, I think it's, I'll chime in here quickly just to say that there's a lot of content in the slides. If you are watching the clock, you might notice I don't think we're going to get through the rest of the slides by the end of this presentation. So I'll turn it back over to Scott, but just did want to mention too that even if we skip past something that you'd hope to hear about, feel free to contact one of us and we can talk about it one-on-one.
Yeah, absolutely. Next slide, Kyrie. So yeah, as we've talked about, there's been a lot of changes to 21. There's a lot of potential changes still for 21 or especially 22. So I think what we're doing with a lot of clients is running projections, looking at how the year's gone for their business on the investment side, and then either accelerating deductions, deferring income, kind of traditional strategies, or looking ahead to see kind of what's going to be different. Are we dealing with excess business loss rules? Are we at potentially higher rates next year because of this increased potential surtax, that $10 million? There's a lot in play there. Probably the biggest planning areas around for individuals at least tends to be charitable contributions. So we're going to get in a couple strategies real quick here as we close out. Go ahead and go to the next slide, Kyrie. This is a great chart, and we won't spend long on it, but just it shows, kind of the effect of this increased standard deduction. And so if you're doing 5,000 or 10,000 per year of charitable contributions, it may not be enough in any given year to get above that standard deduction. So what you can do, a really simple strategy is just to bunch those contributions all in 1 year and do a lot kind of in 1 year instead of all at once, instead of over time. So, if you're doing 5,000 per year, if you have the cash flow or ability to do 25,000 all in 1 year, then you'll get up over that standard deduction and then get more benefit over like a 4 or 5 year period there. Next slide. And then a few other just really popular methods. I think we'll kind of hang on this for a second. But so Jen talked about the 100% AGI limit for cash donations. That's a big deal if you have large charitable intent, but your income's not that large. You have the ability to kind of wipe out all of that income using cash donations. Remember that ones to a donor advised fund or stock or non-cash don't qualify for that. Looking at whether to accelerate gifts to 21 or do them in 22. And I think it's important to run the numbers on this and work with your advisors. It's not always as straightforward as you would think. You may have a large transaction occurring in 21, but if it's a large capital gain, your overall tax rate may still be fairly low. And so doing that charitable contribution in 22 may carry more benefit if you have more ordinary income or subject to some of these higher, potential higher tax rates. QCDs are back in 21. You were able to do these still in 20, even though there weren't RMDs. But if you're now, because RMDs are back, required to take an RMD, you can transfer up to 100,000 directly from your IRA to a charity, and your broker can help you with that. But it basically excludes that income from your return. So it's a really good strategy if you're a retiree or doing a number of charitable contributions at year end, to just do that directly out of your R&D, to avoid even having to pay tax on it. And what that's doing is giving you really a state tax benefit too, if you're in Ohio, because that income now is not being taxed by Ohio because it's excluded from your income, versus a charitable contribution is after the starting point for Ohio tax. So it can give you a little bit of state benefit. Donor advised funds, I mean, these continue to be very popular because they allow you to do a lot of the timing that we're talking about. So you can transfer cash, stock, to a donor advised fund and get the charitable contribution when it goes into the fund, and then that fund can distribute out to charities over time. So when we talk about things like the bunching strategy of like making more than 1 year's gift at once, even just 2 years, 3 years, you could do that and pair that with a donor advised fund if you don't want the charity to get all the money up front, or you don't know yet which charities you're going to give the money to. You just have a number in mind, then that's where a donor advised fund can be really powerful. It can still invest the money. It's really easy to get the money to charities. They handle stock donations really well. I cannot recommend those highly enough. And all the brokers have them, as well as the Columbus Foundation here in town. Next slide, please. So I think we talked a lot about the cash limit of 100% this year. Appreciated securities are still at the 30% limit for long-term capital gain property, but this can be a really powerful tool to avoid paying tax on highly appreciated securities. And we're not going to go through the example here in detail, but essentially you're excluding all of that gain and getting the fair market value of the stock as a deduction. So it definitely results in more money going to the charity compared to selling the stock and gifting the after tax proceeds. Next slide, please. Yeah, so I think the other items here, I mean, we've hit on a couple of these, would be, there are some kind of charitable lead or charitable remainder trusts, without going to the weeds too much on these, with interest rates very low right now. These can be really attractive vehicles to make large upfront charitable contributions, but still provide an income stream or an ability to get money out of your estate over time. And same with the charitable gift annuities. So there's a lot of different more sophisticated planning too around charitable giving that can be done. And we're seeing more and more of these because of the constant changes in income tax rates or potential changes coming down. With that, we're going to skip to, I think, the end here, the third code word. If you can go to slide 34. So make sure to record tax here in the poll to get CPE. Again, tax is the third CPE word, so make sure to answer the poll there to get CPE credit. And as we just wrap up, again, thank you for your time today. We know this is a busy time of year and that you have a lot of other things going on, but we appreciate your time. We look forward to working with you all, both before now and the end of the year with year-end tax planning, and also kind of going into the 2021 busy season here in 22. If you have questions, feel free to reach out to us. If there's anything in the presentation you'd like more info on. And again, don't forget to RSVP for our business tax update that's tomorrow. So we will continue to keep you updated and publish tax alerts as the Build Back Better Act or any other legislation passes. And thank you.